Hello everyone, it's Friday, December 19, and today we will examine the charts for the euro and the British pound to identify potential market trends. The euro edged higher yesterday, though its reaction to the European Central Bank meeting was largely muted. As widely expected, the ECB kept interest rates unchanged for a fourth consecutive meeting, leaving the deposit rate at 2%. Policymakers noted that inflation remains close to the target, while the euro area continues to face geopolitical risks and global uncertainty. Several ECB officials signaled that the rate-cutting cycle has likely ended, stressing that future policy decisions will depend on incoming data and the economic challenges expected next year. Updated forecasts pointed to a somewhat faster recovery in the Eurozone, with inflation projected to return to 2% by 2028. However, the Euro's response was subdued as market attention was firmly focused on US inflation data. Meanwhile, the British pound also strengthened, supported by the Bank of England's decision to cut interest rates while signaling increased caution over the pace and scale of further easing. This suggests that BOE may slow or pause its rate-cutting cycle next year, opting instead for a data-dependent approach as inflation remains a key concern. At the same time, the UK's growth outlook remains weak. This view is reinforced by recent GDP figures. Sterling benefited from softer US inflation data. US consumer prices rose just 0.2% month-on-month in November, while annual inflation eased to 2.7% from 3%. Core inflation also showed a notable slowdown, remaining flat on a monthly basis but declining from 3% to 2.6% year-on-year. Together, these figures strengthen the case for the Federal Reserve to continue its rate-cutting cycle. Now let's turn to today's macroeconomic calendar. It features Germany's consumer climate and producer price data, along with euro area current account figures. However, these releases are unlikely to significantly influence market direction, suggesting that the euro may remain range-bound. And the UK retail sales data for November is due, with forecasts pointing to a 0.5% monthly increase. A stronger-than-expected reading could lend support to the pound and allow it to extend its bullish run. Traders may also pay attention to the Confederation of British Industries Distributive Traders Survey. In the US, the focus will be on existing home sales, consumer sentiment, and inflation expectations, with the latter likely to attract the most attention. Upbeat data could support the dollar, putting renewed pressure on both the euro and the British pound. Turning to technical analysis, the EUR USD chart suggests scope for a near-term correction in the euro. Sellers are likely to become active around 17.29. A false breakout at this level would generate a sell signal, dragging the euro down to 1.1706. A break below this mark could open the way to 1684, with further downside potential towards 1649. At this level, I would recommend going long on rebound, targeting a 25-30 pip move. Long entries at 1706 and 1684 would only be relevant following a false breakout. If selling pressure around 1729 remains limited, the euro is likely to continue trading in a sideways range. In this case, it would be wise to postpone short positions until there is a false breakout at 1754 or rebounded at 1776 in anticipation of an intraday correction of 20-25 pips. As for the British pound, there is still scope for further gains, although the most likely scenario points to continued range-bound trading. A false breakout at the 33.70 support level, potentially driven by stronger-than-expected UK retail sales, would generate a buy signal and could lift sterling toward 34.02, with further upside possible 34.26. At this level, it would be prudent to consider short positions on a rebound, targeting a 25-30 pip pullback. Short entries around 34.02 should only be taken in the event of a false breakout. A sell signal would also be triggered if the price breaks through and holds below 33.70. The initial target would be 33.41, with further downside possible toward 33.12. At this level, traders could consider going long on a rebound, aiming for a 25-30 pip recovery. Long entries at 1.3341 and 33.70 should only be taken in case of a false breakout. Good luck to everyone.